The purpose of this video is to provide you with some background on dividends. As dividends is identified in IAS 1 already, it is a topic that you will encounter early in your studies. There are several types of dividends, and the type of dividend originates in the type of shares we have available. For example, you may have heard of ordinary shares and preference share capital. Preference share capital, as the name alludes to, are those shareholders who have priority or preference at getting dividends when dividends are declared. Preference dividends are usually issued as a fixed dividend amount per reporting period, while ordinary dividends are variable from period to period if there's a declaration. There are several types of preference shares. For example, the cumulative preference share. This implies that there is accumulation of a dividend over time. Although not declared and although not a liability, when a declaration does take place in future, these shareholders will become entitled to the dividends over the periods that they have held the shares and no dividend has been declared. Non-cumulative preference shares just allow you to accrue the dividend for the one period. If no dividend is declared in that period, the right to that dividend is forfeited. Redeemable preference shares are a liability. That is because these shares entitle the shareholder to a repayment of the capital amount contributed in cash at a future point in time. Accordingly, these amounts are not recognized as dividends but as finance costs. Convertible preference shares convert at some future date into ordinary share capital, but are still considered to be equity. Participating preference shares have the benefit of participating in the preference dividend, but also in the variable ordinary dividend in the period that it be declared. There are three important dates for you to consider in the dividend cycle. Firstly, when the dividend is proposed, then declared, and then finally paid. Considering the dividend proposal, at this point there is no liability obligation on the entity's behalf. It is merely a proposal by the directorship to the owners of the entity that perhaps a dividend needs to be declared. While there is no recognition at this point and no presentation as a result, there is disclosure of the proposed dividends in the annual financial report. This note will allude to the amount of the ordinary dividend proposed, as well as the preference dividend, and the fact that it has not yet been authorized by the meeting. It will also provide an indication of the amount per ordinary dividend. You will note there is no amount per preference share, as this is a fixed amount associated with the share over the share's lifetime. Following the proposal of the dividends, these may now be authorized at the annual meeting and these dividends now declared. On the screen you see the general journal that will initiate from this, a debit to the ordinary dividend and a credit to shareholders for dividends. Although it is a debit, please do not think of ordinary dividends as an expense. It is a distribution to the equity holders and is accordingly seen in the statement of changes in equity, rather than in the statement of profit and loss and other comprehensive income. The liability side will be seen in the statement of financial position and will be shown as a current liability, assuming that it will be settled, which in all likelihood is the case, in the next 12 months. Dividends per share needs also to be disclosed, and again we disclose it at the bottom of the statement of changes in equity. Practically, when there's a dividend declaration and payment, there is some confusion among students as to who is entitled to that dividend, particularly if there's been a sale of shares between an old shareholder and a new shareholder. Which of these shareholders would be entitled to it? Consider the example that shareholder A may have held that share for the entire period and then sold it the day before the dividend declaration to shareholder B, who now owns the share. It may seem unfair that shareholder B would receive the dividend, as he has not held the share for the period reported on and covered by the dividend. Shareholder A must therefore include in the price that he sells the shares to shareholder B an additional amount to cover the dividend that is forfeited. Dividends are paid to shareholders that are registered on a specific date, regardless of the period that the share may have been held for. Shareholder B may be the owner of the certificate for 1 day, 1 year, or 10 years. That doesn't matter. The fact that he holds it on that date that is registered for the dividend declaration, that's all that counts. A further scenario to consider is what happens if the dividends are declared after year end. The directors may have in fact proposed these before the year end and a note disclosed accordingly. However, the declaration only happens at the meeting after year end. Is there a liability at year end? Well, IAS 10 is very clear on this. There is no liability to be recognized, only the note to be disclosed, so no accounting entries take place. Remember that at year end, your statement of financial position is a photo of what is happening on that day. And on that date, there is as yet no liability, as the liability only comes into existence when the shareholders authorize the dividend. The third date and final date you need to be aware of is the day that the dividend is paid. At this point, you have a liability in your books, and now it's just a case of settling that liability. As stated earlier, in your statement of changes in equity, right at the bottom, you will disclose the dividends per share. This is calculated as the dividend declared and paid, or the dividends declared, divided by the actual number of shares on hand at the date of declaration. This amount may change with the subsequent issue of shares. It may also change when one considers earnings per share in terms of IAS 33, where there may be a capitalization issue that we need to adjust for. This will be dealt later with earnings per share. To conclude this video, we provide an example of the disclosure and presentation of dividends per share. You will note that the first two amounts showing the dividends per share we will generally show in the statement of changes in equity right at the bottom. Further, however, here is a nice example of the narrative disclosure for when dividends have been proposed but not yet declared.